Good morning, good afternoon, everyone. Welcome to another edition of ARIVE Partner Spotlight. Thank you for joining us today on a beautiful Tuesday morning here in Bay Area. We're really fortunate to have three amazing guests who have joined us today. They are my close friends, they are big ARIVE champions, and we are really excited to hear what they have to talk about credit reports. That's the topic of today's session. As a lot of you know, credit costs have gone up significantly over the last 3-4 months. So we'll hear what our panel has to say about the reasons for increase, what strategies they are adopting in their business, everything around that. In fact, I was at an MBA conference last week here in Bay Area. Credit ordering is a big topic everywhere. Every loan originator, people in capital markets, they're all talking about what's going on with credit because it is so foundational to how mortgages are done. Looking at credit risk is kind of one of the most fundamental aspects of giving a loan. That's why it's a very important topic today and in coming months. So before I hand over to my host, Amy Hulett, I want to mention one thing about our panelists. These three happen to be the first, as I see them. Brendan McKay, who's the owner of McKay Mortgage and also president of advocacy at AIM, was one of the first users of ARIVE. Gordon Chin from Advantage Credit, they were the first credit company that joined ARIVE, and they've been a fantastic partner. We have more than 34 partners today, but they were the first ones who took the plunge. And also Enrique Braunschweiger. Did I say that right, Enrique? So he was also one of the first.
You got 70% of it. It's good enough.
So he's a broker owner of First West Financials. He was also one of the first users of ARIVE. I remember spending hours with him on calls on how he runs his business, how he uses CRM, everything about his operations. So again, we are so thankful for all your support and everything you have done for the community. For those who don't know, Brendan actually published his entire workflow, how he runs his business, videos, tutorials, all on Brokers of Better Group. And they're also available, I believe, in their AMP portal.
Yep.
So again, thank you, all of you, for joining us and taking time off your busy schedules to join us today. And with that, I'll hand it over to Amy.
Thank you so much again for joining us, sharing all of your wisdom with our community today. So thank you again for your time and just being really amazing partners with ARIVE. So just to kind of kick this off, there's been a lot of changes as we rolled into the new year. Credit report fees have been pretty stable and pretty non-exciting for a while. And then 2023 rolled around and everyone went, boom, what happened, right? One more change in the industry. So Gordon, can you kind of walk us through what happened at the beginning of the year with credit report fees?
Yeah, absolutely, Amy. And thanks for that introduction, Harish. Appreciate that. So this whole price increase really took the credit reporting industry by surprise as well. I mean, we first found out about this in October of last year. So credit companies got an announcement from Fair Isaac at the end of October, pretty much stating that they are changing their pricing model into a 3-tier pricing structure. So, and even before telling you about that, I mean, really, I've been in the credit industry for about 25 years now, and prices, it typically go up about $2 or $3 a year, and that's pretty consistent. So for the last 20 years, that's what we've been seeing, $2 or $3 increase total. So this year, we found out that Fair Isaac had an agreement with the 3 credit bureaus for the last 20 years. So that limited how much they can increase their cost by. And that agreement terminated last year. And that's what happened. So now Fair Isaac is free to charge what they want. And they took advantage of that for sure. So what they did was they changed their pricing tier. So they selected 46 of the largest lenders in the nation and said, for those 46 lenders or institutions, we're only going to increase their cost by 10%. And then the second tier was another six lenders that they selected and said, we're going to increase their fees by 200%. So not only, but 200%. And then the third tier is the rest of us. I mean, most of us in the mortgage industry, we're talking small to medium-sized mortgage companies or even large mortgage companies. That third tier, they increased their fee by 400%. So I would think the majority of the AIM members or ARIVE users fall in that category. So they're seeing an increase of 400% on the cost of their credit scores. Significant increase for sure. It's impacting just almost every mortgage broker out there. And, that's what's driving this major increase this year. Every credit company has to pass that on. No credit reporting agency is immune to that increase as well. So that's the driving force behind that increase.
Thank you. Definitely everyone's been affected by this, and there's been countless chatter, conversation, discussions about, strategies on how to mitigate the cost. How do we implement this in our business right now? So I'd love to hear from Enrique and Brandon on, what strategies are you employing this year to mitigate these costs and kind of keep pushing on in your business? Enrique, if you could kind of share first, that would be great.
Yeah, absolutely. And thanks for having me. Love ARIVE. I'm a big champion. Like you said, I tell anybody that will listen that they need to switch to ARIVE. I love it. But yeah, absolutely. One of the things about credit that's very interesting is that we as loan officers have a connotation, right? We deal with it at a different level that our customers do. Our customers don't think about credit on a daily basis. They don't think about running credit or what it costs, hardly ever, right? We deal with it every minute of the day. And I think one of the biggest challenges we have is that a lot of us are feeling jaded or negative because we know what's happening. We go, okay, you're increasing me by 400%. And then you're turning around and selling the data to all these other mortgage companies, right? And you're making hundreds of dollars on those. It's like, what the heck? So we live under this terrible, these people are the devil connotation, right? And sometimes that attitude transpires into how we deal with the customer and how we explain things to the customer. So we have to learn, first of all, to separate that because, the customer doesn't need to be involved. I just recently hired someone who came from a bank and he says, oh no, the moment they apply, we charge them $500 and we charge $500 for an application fee. And I go, really? Do you have any problems collecting the? No, everybody pays it, right? Last year, I applied for a commercial loan, $1,500 application fee up front, right? And yet here we get really worked up about, well, do we charge? Do we not charge $70? Because it's our own mind that's struggling. But before we get into the discussion, I can tell you that everybody has to have a strategy. One of the things that I tell loan officers who ask me, and even people in my office, is what is your strategy, how you're going to handle the credit reports? You need to know, are you going to be doing soft pulls? Are you going to be charging the customer? Are you going to do soft pulls and then charge the customer? Or are you going to pay for it once they go in escrow? Everybody has a different strategy and there's no right or wrong strategy. You have to have one though. And I think that part of the challenge we have with loan officers is they don't have a strategy. They're trying to figure out, well, send them a soft pull link or let's do a soft pull. Let's do a one bureau pull. Let's do it. Do we charge? Do we not charge? And I think that one of the encouragements I give people is sit down and figure out how you want to present this to your customer and do it in a way that is cohesive and it makes sense and it's articulate and you have good emails to go out and explain to people what you're doing and present it like this is how we do business. 99% of the customers are going to comply, right? Be fair to the customer and don't make a big deal about it. That's my initial thought.
Yeah. So being transparent and confident is super important, right? I mean, explaining that these are not laws or changes that you imposed or that you're just explaining what's happening. This is what it is. But again, not going down in the negative, land of, oh, I know everything's just so expensive and I'm sorry. And this is increased and this and that, right? They don't need to know, just this is what we're up against. Everybody's kind of playing under a certain set of rules and being able to provide that confidence and guiding them, through the stages with you is why they're using you and not potentially some other originator. So thank you. You did mention soft pulls, so I definitely want to go into all of that in a second. But Brandon, can you kind of share with us how you're using different strategies right now?
Yeah, I mean, honestly, soft pulls is the biggest difference in my strategy, but To Enrique's point, and I'm actually curious about some of the stuff he's doing because I know he's in a very different market. I don't think there's one answer for everybody. What we're doing at McKay Mortgage is we've put a lot of thought into, but it also like it makes sense for our market and our client profile, which might be very, very different from a lot of the people on this call. So I don't think there's a one size fits all answer. You should look at all the new, potential ways to navigate this increase and go about it in the way that makes the most sense for you. But like, yeah, I mean, I have not mentioned the credit score increase cost to a single client. Like at $35, $75, like that is not going to make or break a transaction, So the thought of mentioning them has never crossed my mind. And if you're out there doing that, I would definitely recommend stopping because it's just putting negativity on the beginning of the transaction for sure.
I will mention if anyone has any questions, we have these amazing guests here. Feel free to put them in the Q&A tab below. So we will be monitoring them and taking them as they come. So if anyone has any questions for our guest, absolutely feel free to put them in our Q&A tab and we'll take them as they come.
Definitely.
So I'd like to be able to now share my strategy, exactly what I do. So one of the first things that we did is we put a lot of thought into it, like Brendan said. And what we do is up front, we actually explain to people the entire process. We traditionally send a link to an online application. And in that online application link, we tell them up front that we are going to do first a soft pull. And we actually spin it from the idea that, hey, a soft pull is actually good for you and good for me because it's not going to hit your credit. All that fear that people had, people were more concerned about it's going to cost me points than it's going to cost me money. Right? So, hey, a soft pull is going to keep you where your credit doesn't get affected and it's phenomenal and it gives us a great picture. However, at some point in the process, we're going to ask you to pay for your credit report and we'll send you a link to do that. And that is at a point when we are ready to start making offers or if we need to dive deeper, like say we pull a soft pull that is in the 619 range. We're going to want that try merge because we want to be able to run DUs to make sure we're going to get these people approved. But we are upfront. We tell them right up front how it's going to work and what to expect. And we do that because you're not necessarily giving them later more information like, oh, now you want money. They know upfront that this is what we're doing. But we spin it from the idea that the soft pull is actually a good thing for them, right? The second thing that we do in that same email at the bottom is we do the opt-out option, right? We explain to them that after we pull the credit, you may get phone calls, and unfortunately, it's not our fault, but we want to give you the opportunity to opt out, and we send that out. So transparency, one solid email goes out.
So you mentioned the soft pull. Let's kind of take it back a step and kind of explain for our audience, what is a soft pull? What are typically the cost ranges? What's the benefit of a soft pull? Why does it even exist? Maybe Gordon, if you could share with us your knowledge on that.
Yeah, absolutely. And I think the process that Enrique is taking is a perfect process. I mean, that's exactly how I am advising brokers to do as well. So that's great, Enrique. But one of the things I do want to kind of demystify about the soft pulls, a lot of LOs, they're aware of soft pulls, but maybe they don't know the ins and outs and really the nuances of the soft pulls. So I can say, first thing is it's not a condensed version of the credit report. It's not something that's different. A soft pull, you are getting the exact same information as far as liabilities, account information, payment history, the credit scores are exactly the same. So the soft pull does provide the same information as a hard pull. So you're not getting anything that's a shortcut of the report or a condensed version of the report. And of course, the soft pull does, it's a soft inquiry like Enrique mentioned, so that doesn't impact their credit scores. It doesn't alert your competitors, so it's not going to generate a trigger lead from the bureaus, and that's a huge, huge benefit. And then lastly, the cost is a lot less. Soft pulls average cost is maybe anywhere from $2 to $6 per bureau, as opposed to a hard pull that's on average now in the industry $60 to $80 for a tri-merge. You can get a soft pull for about $12. So it's a significantly lower cost, of course. So those are really the three main benefits: the inquiry, the soft inquiry, the no trigger leads, and the lower cost.
Got
And
it.
it's all the same information. And I would also add that a soft pull can also be imported into your LOS. You can import a soft pull into ARIVE or any other LOS. You can work the numbers, you can see the DTIs. So you can do all of that with the soft pull. You just can't reissue it to DU or LP for findings at this point.
At this point. And there was a question in the chat about being able to do it with the AUS findings, and that's in the test phase right now. So Fannie Mae has given a couple of lenders, United Wholesale being one that I'm aware of, the ability to run AUS findings with soft pulls. And hopefully in the near future, that is available on a wider scale. And I know there are plans eventually to use a soft pull for as far down the process as possible, which would be amazing. If you could use a soft pull all the way up until clear to close, you would literally have zero fallout on credit report fees. And this, do you charge up front, do you not, becomes a non-issue. And trigger leads do too, right? Like that fixes the problem of trigger leads without banning trigger leads, because good luck stealing a purchase 5 days before closing. You know what I mean? So that kind of stuff is in the works, but it's not available everywhere yet.
I have a comment. Somebody obviously says they're not getting the same information, or they don't think they're getting the same information. You already addressed that, but something silly. If it's the exact same report and we're in the process of eventually being able to run AUS, then why not? I mean, they're identical reports. Why a soft pull versus a hard pull? I mean, is there a reason for that, Gordon?
Yeah, I mean, there are some differences that we're just not seeing on the report. So when a soft pull, if a soft pull were to be reissued to AUS right now, your standard soft pull does not have any trended data information in it. So the AUS, they're looking at trended data, 24-month of payment history to determine their findings. And that's not part of your standard soft pull. The pilot that Brendan just mentioned, certain lenders are piloting the ability to reissue soft pulls. Those soft pulls actually do have trended data in it, so that's a little bit different. But right now, the standard ones do not.
But, and to Teresa's specific question, where it starts, are you running one bureau? We were doing one bureau up until actually this morning. We made the decision as a team to do two. We were initially doing only Experian because it's the cheapest. But we found that, especially with people that, more often with people with less than perfect credit, sometimes stuff shows up on one bureau but not the other, right? And I'm not going to tell you I have any data to back this up, but TransUnion seems to be the bigger offender of the three, where stuff is either showing up that's not showing up other places or vice versa. So as of today, we're doing two bureaus, and it wouldn't shock me if we just went to all three on the soft pull at some point, because I bet you that is where you're seeing a difference in information in doing one bureau versus three, more so than doing a hard pull versus soft. That would be my assumption.
Yeah, and
These are great questions. I'll just add into Brendan what you said. Like even at ARIVE, we have been in touch with agencies like, can brokers at the point of origination use soft pulls to run AUS? And at this point, like you mentioned, the report has to be issued by a lender, and when you are at the broker, the agencies don't know where the loan will go. So that's kind of what is going on. But, with your advocacy efforts and everything else you are doing, hopefully.
That's nonsense.
That's kind of the official answer. Like, they have not said no, just to be honest, they have not said, no, we're not going to let you. They're just saying, look, we are analyzing this. And like we talked about, this has been around for 20, 30 years. So changing that process has significant implications, how the file is viewed and underwritten and what happens to that. So hopefully in next, year or two, soft pulls will get more and more popular, even at the point of sale or at the broker's origination platform. We can actually run AUS findings, get some hits upfront. But Amy, you were saying something? So
yeah, I was just going to add for our brokers and viewers that if you don't have a soft pull account, we have many credit partners that are in ARIVE that you can absolutely reach out and get those credentials. Some have a separate set of credentials just for soft pull that you would be using, right, to differentiate between a hard pull and a soft pull when you order. But then you can use those within ARIVE as well. So we have tools and support articles on our support page as well, but definitely reach out to your credit provider too. If it's Gordon or another company we partner with, to be able to utilize that tool. It's super important right now. And as Brendan said, like even just, okay, they started out using one, now they're going to pull a second one. We've seen huge variances from one bureau to the next. And so I would think you would probably have a better idea of maybe pricing that could be affected
Well,
from one to the other.
And that was really what drove the decision for us, because if you have two bureaus, you know what the worst case middle score is, right? We're also noticing that previously lenders, once you had over a 740 credit score, that was the top pricing bucket. I'm noticing more and more that they're going 760, 780, and some even up to 800. And it's actually something I want to start talking to more brokers about, because it matters. Like I priced one out today. It was a 50 basis point difference between a 740 and 800. And a lot of times that's just somebody with perfect credit that, they all they have is credit cards they pay down at the there's a balance reported, but they actually pay it down every month. So that's where we were coming from with that, and starting advising people for that for sure.
Great. We touched on, trigger leads, opting out strategies. You kind of talked a little bit about that, Enrique, with if you can kind of, I guess, share with us again, when you send out this opt out, what stage was that in? And have you pulled a soft pull, not a hard pull yet? And is it application, or is this even when you're just sort of talking to them about, a pre-qual type initial lead conversation?
Yeah. So the first thing that I've done just over the last few months is I've actually touched base with my entire past client database. This is the first recommendation I'm going to make to everybody. If you have not talked to your past database about opting out, you got to do that. Your past clients may not be looking for a mortgage right now, but they will. And when they do, you're going to get trigger leads, right? So it's great to have companies like Stickum, who's a named partner, that will give you notifications if people get pulled credit. But to educate your database that you don't really want this calls is a great thing. And send them the link and say, hey, sign out, right? It's gonna take you out of all those telemarketing calls. So I did that with my past client database, and I do that at least twice a year, where I send that email, I record a video, and I explain to people why. I'm actually letting people know about it at the first contact when I'm sending them the application. So I have an email that says, congratulations, we're excited to work with you. Here's the link to the application. We're gonna run a soft pull. Eventually, we're gonna run a full report. It's gonna cost you money. And by the way, you may get phone calls, and here's the opt-out. So I do it all there at once. I also, at the time of the application, when we're actually ready to run the soft pull, we send another email and another text message letting them know that even if they opted out, it's possible they're going to get phone calls, because we know there's a delay from the moment you opt out to the moment you actually get removed from the list. But we tell them, we remind them, say, hey, you're going to get calls, be prepared, ignore them. They're telemarketers. I said, these are not mortgage companies, they're telemarketers. That's my position on it, right? I know everybody's different. There's people watching this who are buying trigger leads. That's okay, God bless you. I believe they're telemarketers, and you don't want to deal with them. So I do that fairly upfront in the process, and then I do it right before I pull the credit report. Another thing I wanted to mention too is the fact that there's also that other option where a lot of loan officers, they're not doing the soft pull. They're just sending the link to the customer to pay up front, right? If you're running 10 credit reports a month, you send 10 links out, and that's what they do. And, there's nothing wrong with that either, right? There's people understand that, I mentioned my wife and I applied for a commercial loan. We're buying a building, and $1,500, they want me to write a check on day one, and my wife looked at me and I looked at her and I go, well, write the check. We won the building, right? It's like, what are you going to do? Not like argue with a guy
around, spend a bunch of time.
Yeah. So was that great? No, but $70, $75, you want a house and you want to get qualified? That's not a big stretch, right?
Yeah. And I think I've heard a lot of brokers or LOs kind of just, they're not confident in, I think, their business. So they're like, well, what if they don't use me because I'm charging it up front, and are they going to pay it right? And that's just in my opinion, terrible. Terrible approach. It's like, are they going to use you at all? Because are you confident in being able to educate them as why things are the way they are?
I just brought a guy on from Union Bank. Says you cannot move from point one without the credit card for the $500. From point one, Wells Fargo same way. You cannot even complete the application until you have this fee collected, right? So it's like, we are creating we're creating the problem. We're creating the objection from the customer. The customer's not going to have it.
Yeah, and I think that's another reason to use the soft pulls, because aside from the cost savings component, if you're dealing with maybe some new prospects and they're not comfortable with you, you don't have a relationship with them, they're less likely to let you pull a hard pull and pay for it, right? But if you say, hey, don't worry about it, this is a soft pull, there's no cost to you. And if they're more likely to agree to that. And once you do that, then you're already in the door. And then you can start talking to them about their credit and then about what type of programs you can get for them. And then once they're invested, a few weeks after a few weeks of conversations, then they're not going to have a problem paying for a hard pull at that, later on. So it's really a good tool to get new prospects too. It's not just for cost savings purposes.
So we are getting some great feedback. Soft pulls also give you time. When you do opt-out screening, it takes some days before opt-out gets into effect. So some of our audience has mentioned, doing soft pull early on will give time so that opt-out screening gets enough time so they're actually opted out. It takes a few days before when you register, and a lot of our brokers in ARIVE send that link as a part of initial request. In ARIVE, you can configure email. So what we have seen our customers do is put that in that email template saying, hey, if you have not opted out, opt out. And then when you do hard pull few days later, when they're shopping, at that point, they would have opted out as much as possible. There is still trigger leads like our guest mentioned, we cannot do away with them, but at least it will reduce the impact.
Brendan, are you
Correct.
able to kind of share with us more about trigger leads? There's a lot of anger that comes from LOs and brokers, of against these trigger leads, and sort of they feel very protective over their client, and now they feel kind of sold out, right? It's like I'm partnering with these credit bureaus, and then they're selling the data, and then now it's coming from my business. So can you kind of share what you know about that side of it, and maybe just a mindset that brokers and LOs can have around this topic?
Sure. I mean, they should be mad. Like it's bullshit what happens. It's just like a completely crooked business model. And it sucks. So I understand how mad everyone is about it, and it impacts their bottom line. Even if like the worst case scenario is you lose a client because of it. And even like the best case scenario is your client's super annoyed. Like you've just started this like supposed to be really positive experience. We're going to start buying a house, yay, and they get 150 phone calls over a 2-day period. That sucks, and they might even blame you for it mistakenly. Like the whole thing absolutely sucks, and I get that. Outright, and this is like this soft pull is definitely going to help. So like, and this is getting into some of the advocacy stuff I'm doing. Outright getting them banned is going to be incredibly difficult to the point of being impossible. There's a very weak argument, but an argument that it gives consumers more options. Obviously, I don't agree with it, but that backed up with a lot of money to advocate for it gives reasons not to. But the good news is there's a million ways to solve the problem without outright banning them. So like one we've already kind of talked about, if we can push the soft pull process further and further down the road, like right now, I'm just doing an initial pre-approval. Once we're writing offers, I do a hard pull at that point. Honestly, for a lot of clients, I might even push it further to offer accepted. Like if I know there's no way that I'm not going to get AUS approval type of thing. But if we can start, running AUS with it, if we can start disclosing based on it, we can start doing everything short of sending out closing docs or even sending closing docs out. Like while trigger leads are still legal, their business model has been completely taken away, right? The other side of it is cleaning it up. So not only are the fact that trigger leads exist offensive, but like the way that they go about it and how misleading they are. They make it sound like it's you or it's someone from your company reaching out, and they're very purposely vague about it. That needs to be cleaned up. And the other part of it is right now that violating the do not call list fines are embarrassingly low. It's a line item on these companies' business expenses. If we could fix those two things, once again, trigger leads aren't banned, but 95% of the companies that practice it, their business models no longer work. So that's the way we're going about attacking it and fixing it in DC.
Yeah, people are asking for the link to the opt-out, and I'll be fair with you. I don't want to switch screens because my computer is glitchy. But if you literally Google "do not call," it'll give you the link. to the do not call. And somebody asked if you can do it on behalf of the customer. It requires personal information, and it requires for you to attest that you are the person opting out. So don't do it on behalf of the customer, please. Stay compliant.
Yeah, and just to give you the website for it, it's basically just www.optoutprescreen.com. So optoutprescreen.com.
Yeah,
Thank
and just to add, a lot of our users have been finding ways to share this information early on in the stages, whether it's that initial conversation, part of the application, uploading that information. We have a client needs rule they can create to, engage them in that process as well. So there's many ways that you can use these tools and in the way that benefits you and your customers. But the message definitely to try to kind of at least dabble in that, get the soft pull credentials, play around with it, figure out how you can create processes when talking to borrowers, have confidence in why you're doing it, and ensuring that it's successful for you and the client. Do we have any questions, Harish?
Yeah, so Gordon, do you want to restate the cost of soft pulls? I think there are some questions, I think, and it is specific to the credit company, right? It is not consistent across. So can you explain what Advantage charges? So
Yeah, absolutely. Well, Advantage Credit charges $2 for Experian, $6 for TransUnion, and $6 for Equifax. So you could do a tri-merge for $14. And most credit companies, I would say, are probably somewhere close to that ballpark. I mean, I think we may have a better price with Experian just because we have a special arrangement to get a better price from them. But it shouldn't be too different from most credit companies.
also, there's a question, there's this concept of credit pulls, hard pulls will ding the score. Does anybody has an idea like how many points it goes down? It's a couple of points. Anybody has any thoughts?
I have what I tell people, and I'm curious if Gordon will tell me if it's accurate or not. I tell people that it somewhat depends on your credit profile. So if you have perfect pristine credit, you're looking at a couple of points, 2 to 5 points, and it'll bounce back in a month or two. But if your credit is less than perfect, and if you have a lot of pulls and a history of a lot of pulls, you're going to see a significant impact on your score. And I use a metaphor saying it's like throwing a stone into an ocean versus a puddle. It's the same stone, but it has a different impact on it. Gordon, am I bullshitting people, or is that accurate?
No, you're right. And the best answer really is it depends, because it does depend on the consumer's credit profile. But they don't like that answer, of course. So they want us to give them some actual points. So I will typically say between 5 to 10 points on average. And that's a pretty good range. I have seen extreme cases where one inquiry can drop a score 20 points. That's pretty extreme. But if you say 5 to 10, that's pretty average. And also just want to mention the grace period, because each bureau has a grace period where you can pull multiple mortgage inquiries without further impacting the score. So Experian has a 15-day window. Equifax and TransUnion has a 45-day window.
That's why there's okay.
So yeah, so just keep keep that in mind. You have 45 days with Equifax and TransUnion to have multiple mortgage inquiries without further impacting your score.
I also want to put something out there. A common thing you'll hear from borrowers is, oh my God, the last time I got my credit pulled, it dropped 20, 30 points. What's actually happening there is they're looking at the report on like a consumer site, like Credit Karma or their bank or a credit card or whatever, which is a different scoring model, and it typically trends higher. So keep that in mind. It's that's what's actually happening when your borrowers are complaining about that.
Correct.
So if you have somebody shopping though, let's say, and then maybe they're not ready, I mean, it's also a strategy to kind of figure out, use the soft pull to kind of get a peek at what their scores are now. Are they in the market for what they want to do as far as their credit scores? Do they maybe need some credit repair or just some work personally done on their credit right too? But then since you have these grace periods, if you're going to be outside that window, you want to be more cautious about doing a hard pull and then another hard pull 60 days later, and then another hard pull, right? So the soft pull would be also, let's just say you did a hard pull up front for whatever reason, you could do the soft pull, kind of see where things are trending if it's been a few months before you go into another hard pull?
It's like Enrique said at the beginning, like he turned it into a selling feature, and like same. So I haven't explicitly said it, but like we do soft pulls on everyone up until we're making offers, and I sell it. Like during my initial call, I explain, I'm going to send you this link. We're going to get you pre-approved. At initial pre-approval, we do a soft pull. Like, and now I mean, that was a constant request from borrowers. Are you going to do a hard pull on my credit? And I had to give my whole song and dance about how, yes, but it doesn't impact your credit that much, yada, yada. And I got very good at beating that objection back, and it became a non-issue, but like, rather not have to do that at all. And now I don't. And it's much better. Nobody objects to like, they're making an offer on a house. No one objects to doing a hard pull of their credit at that point. Not ever, 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 right? So it is honestly solved multiple problems for me, and I probably should have been doing it sooner.
Great. We have some other good questions coming in. Does anybody know if we can do rapid rescores on soft pulls?
No.
No.
Well,
So yeah, I mean, so you cannot do a rescore on soft pulls, but you can do the what if simulators, wayfinders, so you can use the software tools to give you suggestions on how to improve the score based on a soft pull. But in order to do an actual rescore, you have to pull a hard pull before you can do that.
Gordon, I have a related question that came up on our meeting this morning. So currently when we do a hard pull of the credit, it shows at the top there are 3 scores and then like potential improvement plus 20 points or whatever. Our
Yes.
soft pulls are not showing that. Is that just a formatting issue, or can we not do that?
That is a formatting issue
All right.
and a product, because the potential score improvement is an actual product that's turned on, and there's a cost for that. It's 50 cents per bureau. So
Oh.
that's included in your hard pulls, because the hard
Okay.
pull, cost is more expensive. The soft pulls don't include it, but if you want it included, we can. You just
All
have to
right.
pay an
Oh,
extra 50
I didn't
cents.
know that was the case. That's great.
Well, we'll
That's-
follow up with you after this call. Thank you,
Yep.
Gordon.
Sure.
That's amazing.
We had a question about inquiries. Do inquiries show up on a soft pull?
It's a soft inquiry. So
No.
it does on a soft pull.
Like,
I think
Yeah.
they mean, can you see who else has pulled their credit? Is probably
Yeah, like credit inquiry, history. Does that show up like it would on a hard pull report?
It shows up on a consumer credit report, but I don't think lenders are seeing it, or
That-
your
that is correct.
competitors are seeing it.
Okay.
Yes, so the consumer will see it when, you can go and look at your credit, but, if lenders or banks who are trying to give you a loan, they won't. That's the benefit. That inquiry is
Gotcha.
visible. It's still an opt-in, so you have opted in. That's why you're able to see it.
Okay.
Oh my
Just
God, we have so
a
many
lot
great
of-
questions.
there's a lot of questions.
Yeah, I saw one
There are.
that from Tara Sommer about, pulling a report and then 2 weeks later it dropped by a bunch. I would be curious if you pulled the report, the first report at the end of the month and the second report at the beginning of the month when a lot of stuff updates. But also I would talk to a credit restoration company. A lot of times along the path of credit restoration, in the short term, they do some things that hurt somebody's credit but with the long-term goal of improving it. I'm not a credit restoration expert, but I know that can be the case sometimes. So that might be what's happening there.
And Brendan, there's another excellent question which says, with soft pull becoming so popular, will that become an issue with the bureaus? Because they'll see their revenue drop, drastically. So over time, if this becomes popular, would that overall become an issue, like, having a, 4 or 5 times more expensive product? How do you see that evolving? So,
I asked Gordon the same question recently, and I spent some time thinking about it, and like maybe, but probably not, at least for a while, at least because of how Gordon described the tier breakdown, right? Like a lot of the bigger lenders are not seeing this cost increase and probably aren't changing their business structures in the same way that we are. I'd be curious what like the percentage breakdown is, but yeah, those are my thoughts on it.
Also, a lot of questions about the soft pull in terms of, accuracy and what the best practice is. You got to use your broker common sense. And, the reality is if you're pulling a soft pull and you have a, 623 score and they want to purchase FHA or a 619, I send them the link. I want the 3 bureaus. I want to run that AUS. I want to make sure this person's going to be good before I send them out. You're running a 760 with practically no debt. There's no need. So you gotta understand that you're still in control of your business. And when you issue a pre-qualification letter, you gotta know that, hey, you feel confident that this soft pull is gonna do the trick or not. And I tell my my loan officers all the time, look, you're at 49.9 DTI with a 689 FICO and you want to go conventional. Get the soft pull and run the AUS. You're going to need it, right? It's like you're at the edge of the precipice. Don't risk it. So people have to use common sense in how they are using the soft pull. It's not a one size fits all. A lot of people need to pull a direct credit report and need an AUS. A lot of them don't. I work in an entry-level market where, you know, we turn down a lot of people, and, you know, we have to get really good at this process of making the determination, okay, who gets a letter, who doesn't, who needs a soft pull, who needs a hard pull. And we get better every day, but you got to use common sense.
And
I
Gordon,
do
we
the
cannot
exact-
upgrade
I
us.
do the exact same thing, unless, you know, if their credit's a little rough and I'm not sure about AUS, or if, you know, we're over 45% debt to income ratio, and I know I need to run AUS to be sure, I pull it at that point. I do the same thing.
Yeah, especially because AUS right now is not as predictable as it used to be, right? You knew that you would be able to look at ratios and score and reserves, and you knew.
Yep.
And now it's like it doesn't work sometimes, you know, and you don't know why. And so you got to cover yourself.
So Gordon, we cannot upgrade a soft pull to a hard pull, correct? There is no upgrade. And can you charge the borrower for the soft pull as well? Can you address that?
And yeah, those are great questions. No, the soft pull and hard pull is two different types of reports, so it cannot be converted or upgraded to a hard pull. You just have to pull a new report that's a hard pull. So, and the fees, soft pulls, you can't charge the borrower for soft pulls. You can only charge for hard pulls. Don't ask me why. I get that question all the time. That's just what the bureaus tell us, and that's the bureau policy. That's not, you know, our policy. I wish you could. I mean, you know, why not? But right now the bureaus don't allow it.
Great answer. You know, they are the ultimate authority. So if the bureau says no, it is a no. That's how we take it. So there's a question, I believe, I'm not really sure the intent, like running AUS with soft pull is potentially dangerous. So maybe they're referring to the pricing may not be correct or the results may not be correct. Would anyone want to answer that? Like running AUS on soft pulls, have you seen big changes when you actually ran it later on, or it has been?
No, I think, you know, she's really talking about what Enrique was talking about and using some common sense. And like, if you have a borrower with a 620 score, you know, and you're doing FHA financing and you're sending a pre-approval out based on a soft pull, like I don't think that is that smart of an idea. You know, you really need to make sure that you have an AUS approval, or if you have an 800 score, but it's a 47% debt to income ratio on a conventional loan. You're probably good on that. Like, and honestly, like Enrique was saying 6 months ago, I'd be like, send it out, we're good. Now you just got to run it. But when you have, you know, perfect pristine deal, and we're not even sending out pre-approvals at this point, but I do take the fact that I'm telling someone they're good and they're going to spend their time going out looking at houses. Like I take that very seriously, right? And I don't want to yo-yo people with that. So even in those situations, before I tell someone they're good, they're pre-approved, go looking. If I know they're somewhere in the middle ground or even a slightly like very light gray area, we're going to do the hard pull and run AUS at that point.
Fantastic. Someone also asked, Steve asked, like, can by any chance this can be seen discrimination that you're running some people through soft pulls and some through hard, or anyone has any thoughts on that?
Better question for
someone's going to complain about that. Yeah, it's possible that they're going to claim that.
I'll tell you. So I at this point, we're not charging upfront for credit reports. We never have. And since we're doing it at the time it's getting offered, also like I'm in a market where it is largely perfect credit. There's a lot of competition for the people, and someone can be uppity, sending them a link, whatever. And I'm weak. I'm a weak loan officer, but I do, like, to Steve's question got me thinking about it. The fact that we're not charging anybody, soft pull versus hard pull, the fact that we're not charging anyone, I would think would clear us of that, but I doubt it would be an issue, but definitely check with an attorney on it would be your best bet.
Cool. These are such great questions and such great answers. You know, we still have a lot of questions coming, so we still have some time. So if you have any questions, and are you doing pre-approvals with soft pulls, Brendan? Is that what you said?
Not yet. I mean, I'm telling people they're pre-approved, and the difference might be some nuance on how I actually do pre-approvals. I don't typically write blanket pre-approvals like you're pre-approved for this amount. Go let me know when you get a contract. Like I write the offers specific. I write the letter specific to every offer that's getting made. And I'm happy to talk about all the reasons why I think it's cleaner and better to do it that way on some other time. But because of that, I'm telling people, hey, you're pre-approved, go find a house, you're good in whatever price range you want or whatever nuance is appropriate. And at that point, I've still done a soft pull. Okay. And then when they're like, hey, we want to make an offer on this house, can you send us a pre-approval? That is when I'm doing a hard pull right now. I have been considering kicking that can down even further on borrowers that have 800 scores and 25% debt to income ratio. But I right now I'm still doing hard pulls on them, but that might change in the near future. I just want to marinate on it a little bit longer.
Somebody's asking if prices would come down. I don't see any world where the credit bureau is going to backpedal and go, you know what, we decided to charge you less. Right? I mean, Gordon, that's not going to happen, right?
Well, yeah, I mean, because the only way that prices go down is in what the world we're talking about is more competition getting increased to it. And there kind of is, but there kind of isn't. I don't know exactly how the Vantage implementation is going to go, which is probably what Steve is referring to. But I don't know, like Gordon, the way you were kind of describing it, it's like they're just going to be both of them. It's not like there's going to be this free market of credit providers, of credit bureaus that you can use that would drive prices down. So I doubt it, but I don't know that anyone knows exactly how it's going to be rolled out yet either.
Yeah, and I think, and just to address Steve's question, and he mentioned whether or not price is going to change in 2024, 2025 based on the new scoring models. And it may, I don't know, it's hard to predict right now, but I can say this, right now for the last 20, 25 years, Fair Isaac had a monopoly on the mortgage FICO scores. That monopoly is now no longer existed. So the GSEs already announced that in 2024, 2025, they're going to be accepting 2 new versions of the credit scores. So they're going to be accepting Vantage 4.0 and FICO 10T. And so at that point, that's going to become it's going to change from a tri-merge to a bi-merge. So that's going to now generate some competition between the bureaus, because you have 3 bureaus, but we can use 2 scores. So that means we can select at some point which 2 bureaus we want to use. So now the bureau is going to, obviously people are going to use the bureau that cost the less. So perhaps that could drive competition and drive scores down or prices down. So it's hard to say. I mean, that's a great question. I'm excited to see what's going to happen with that in the next coming years. I'm hoping that the prices do go down for the industry. So there's some hope, but we have to wait and see.
That would be awesome.
Yeah.
So just for background for all the brokers, the FHFA announced a few months ago, like from tri-merge, what everybody is used to, that's what all brokers are doing today. They're going to go to a bi-merge approach where only 2 bureau scores will be needed to actually process a mortgage loan. That's news to everyone. It's fairly new. It's a big topic of debate in the LOS community. ARIVE is working with both agencies because we have to update our LOS. There are new algorithms which are being launched, like Gordon mentioned. They're supposed to be more inclusive. They'll look at rent payments, utility payments. So the reason these changes are coming in is like you'll be able to qualify more borrowers. That's kind of how agencies are looking at it, making housing more affordable. But it's still pretty early days. Competition definitely leads to improvement in cost. So maybe by next year we'll have more to say on this. Maybe we'll have another panel next year to see how this whole thing is shaking out. but great points there. So
yep. That's going to be a huge paradigm shift in the next few years on credit scores.
Well, and you were saying you were kind of excited about it, Gordon, just because it's been this model for so long. Me coming from the lending side, I mean, we would bump up against it all the time. FHA doesn't really require you to necessarily have credit, but then the lenders sort of do. And it became, there's this gap there of like, how do you allow more people to buy homes, give them credit for their ability to repay in other models outside of the traditional credit report, right? It's important.
Correct.
And so it's, this change can breed a lot of good things. So hopefully it's going to be more advantageous for borrowers and costs will go down. We can be
I
hopeful.
agree. Yeah, I'm embarrassed to say I am excited about something like this, but 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 no, you're right. I mean, we need a change. I mean, should help the mortgage industry. It should help more consumers get qualified. It should help mitigate risk for brokers and for the GSEs and lenders. So overall, it's a good thing. And really, the FHFA has been experimenting with this for over 10 years now. So they've taken their sweet time to come up with a new scoring model that's going to be more advantageous for the industry. So at least we know they didn't rush it, because 10 years is a long time to come up with new credit scores. But it's exciting to see how this is going to develop.
So it's going to be perfect from day
Yeah.
one.
Yeah, right.
No revisions needed. We're going to nail it.
Yeah, I do have a question for panelists, if you can. So Gordon, like what you mentioned, so there was a contract with FICO that ended, so they've jacked up the price by 400%, whatever. What prevents this from happening in the future? We have this Vantage score and FICO 10T. Do you foresee? Because, as long as the algorithms are captive by certain companies, what if they go back and do that again? Any thoughts anyone has on that? How do you protect, maybe as a part of advocacy, Brendan, like, how does this not repeat in the future? So not everybody is hit one more time.
Support your trade association. That's how you stop it. So yeah, I mean, it is conversations that we're having. Are we like acting like the world has ended because it's gone from $35 to $70? No, but there are definitely conversations we're having. And also, if it continues to trend in this direction, it will start to become a barrier to entry for people and especially for people from underserved communities. Charging $70 upfront, okay, but like $150 upfront to somebody that's been saving for years to do 3% down, and might be doing a down payment assistance, like that is a real barrier to entry at that point. For a lot of people, the $150 doesn't matter, but if it's like I'm charging $150 and I promise you absolutely nothing, like that's tough. So those types of conversations are things that we're starting to have. We had it with Richie Torres's office, who is behind the bill that got introduced last Congress on trigger leads, and it's going to get reintroduced again this year. So we're starting to make them aware of some of those things as well.
All right. And Enrique and Brendan, how often do you have to go back if you approved someone on soft pull, or you did soft pull and then you did a hard pull? Do you have any instances where you had to go back to the consumer and say, what, sorry, brother, your hard pull is not matching your soft pull?
We actually had our very, very first soft pull that we run. We go 2 weeks later, the very first one, and we had a big difference in score. And what we found out is that, there were things that were not reported, and that's a risk you're going to run. If someone had a late payment or had something and it hadn't reported when you do the soft, that's a risk. We run a lot of them. I'm talking hundreds of them, and we're not seeing it as a constant thing happening. But is it going to happen? You bet. People are crazy. People do crazy things with their credit. That's all I can tell you.
Yeah, I guess I had my first one, but she bought a car, so that it had nothing to do with the soft pull versus hard pull. And I understand the apprehension in switching to a soft pull, because something it's just like I thought that there was some difference between what was showing and stuff like that. Before I started using them, I thought there was this big difference between the two. And that was a lack of understanding on my end. Like I said, I wish I did it a long time ago. The thought of my credit bill doubling is what got me over it. It was a cost thing, right? And I was like, all right, let me educate myself. Let me see what this is really about. But like, if I knew a year ago what I know now, I would be doing exactly what I'm doing right now. Because even without it doubling, my credit report bill is still extensive on transactions that never go through. So it is something I definitely would have implemented before, but I would encourage anyone, just pull one. Pull one, you can't charge a borrower for it, even if you don't change your model. Pull one and then pull a hard one and eat it, and look at them side by side. Look at the fact that the scores are identical, the trade lines are going to be identical. If you pull all three bureaus, I think that you'll see for yourself.
Yeah, and if I can just add to that, Brendan, I know a lot of people that are listening are going to be, interested in pulling soft pulls after this. So keep in mind, you're not all set up to order soft pulls. You have to reach out to your credit provider. ask them to set you up for soft pulls. It may require a different set of credentials, or some platforms use the same credentials, but you still need to get set up before you can pull soft pulls.
Yeah.
Okay.
And also have a conversation with people. You know, if you have concerns and you're not sure, I've dealt with 4 different credit companies, and Gordon is so knowledgeable, but every person that I've ever dealt with my credit companies are knowledgeable people, and they will tell you they're hurting just as much as we are. They're concerned just as much as we are. You know, obviously this affects their business too. So my conversations with some of our credit people have been very positive. They've given us guidance, and they've looked for, hey, maybe this product works better than this. Maybe this option works better than this, whether it's Gordon or whoever you're using. And if you're not happy with what you're using, talk to Gordon. I mean, there's options that people that actually care about brokers, who are focused on our business, who are here to help us, just like ARIVE is, right? This isn't just some vendor that, hey, it is what it is. These are people who are vested in our success and they want us to do well, but you got to have conversations with them and get guidance.
Well said, Enrique.
And Gordon, I gave your email to a lot of people here. So Gordon from Advantage Credit, Gordon@advcredit.com, if you want to reach out to him. So he's available.
Yeah, please do. Happy to talk to anyone and assist in any way I can.
You know, and we've been working with Advantage Credit for years now. We love working with them. And that was, they were a 3rd or 4th credit provider that we switched to, and we love them. We're super happy.
So there's another good question from Patrick, which is on soft pulls, which is the topic of today's discussion. So we do not support in ARIVE a consumer pulling their own credit. There are a lot of other compliance nuances. This is on the application. So ARIVE has a consumer application where when borrower can take the application. So you cannot do soft pulls in that application. We are looking into that, but as I mentioned, allowing consumers to pull their credit and watch their scores has many other side implications, which you have to first address, if you will. But great question, Patrick. Thank you. This is a little bit of marketing, but I'll probably take this question. Brendan, what did you like about Advantage, if you may? Like, did you have challenges with other providers?
they were cheaper. That's what I like the best.
That's a good one. You know, that's kind of black and white. So.
You know, there's other stuff, but that's it. They were cheaper.
All right. I think so UWM is probably the only lender that is allowed to run AUS with. There may be some other large lender. At least that's what the agencies told us. Some very large lenders have been given this pilot permissions. Brendan, do you have more insights?
To my knowledge, I'm only aware. I'm sure UWM's not the only one, but on the wholesale side, to my knowledge, that's the only one. But I could be wrong.
All right. So we are almost at the top of the hour. Any final thoughts? Maybe we'll go one by one. Gordon, do you have any final thoughts on this subject, on this topic?
Yeah, well, I want to say thank you to Amy for saying she loves Advantage Credit. Thanks, Amy. Amber. I'm sorry, Amber. No, I just think that, you know, every broker has their own way of doing business, and you have to do it in a way that's going to make sense for you and your clients. Right. I mean, that's whether or not you want to order soft pulls, whether or not maybe you want to go just straight to hard pulls. There's a lot of options out there. You know, your credit provider is a great resource. I mean, Advantage Credit can help you with anything. There's a bunch of great credit providers out there. Reach out to them, ask them about, you know, best practices, how to reduce costs, how to better serve your clients, how to, you know, prevent trigger leads. That's really a big one. So, you know, please integrate the opt-out into your application process, because right now, more than ever, the bureaus are selling trigger leads. Okay, I mean, every day I get a call from a LO or a broker telling me, why is my borrower getting, you know, bombarded? They've never got all these phone calls in the past. Well, it's because of the industry now slowed down. Companies are looking for ways to make more business, so they're purchasing trigger leads. So it's happening now more than it has the last 3 years. It's not anything new. It's just more prevalent in this market. So right now is the time to protect your borrowers, protect yourself from losing that loan to someone else. Make sure you're implementing the opt-out process.
So Enrique, you have any final thoughts?
No, I'll finish with the same idea that I started with, which is come up with a program, a process. Sit down, write down your process, and embrace it, and then make adjustments. Bring your account executive on your credit company into the process and say, hey, this is what I'm thinking about doing, and practice it and try it, and have your staff embrace it. When the people that are struggling is because they don't have a process and they're just trying different things and there's no consistency. Once you create a process and then you tweak it and it gets better, then it's easier.
Brendan, anything you want to add to that?
I mean, Enrique, I like stole words right out of my mouth. Like the number of originators out there that are winging it on every transaction, not just with this topic, but with everything you do. I mean, it's nuts. Like, you're a professional, write your process down, deliver a consistent, experience to your clients. Even when it comes to stuff like email templates, like, you send out whatever number it is, 50, 500, 1,000, like online application emails a year. And if it's 1,000, one's the best and one's the worst. Like, why not make it the best every single time? And it's the same thing with this. You need to put some thought into it. If you're just like, oh, this change happened, let's see what happens. Like, that's a losing strategy. Like, this is a massive, massive change in a very important part of what we do. And if you're not changing with it, then I'm not going to say you're going to get left behind because you haven't adapted to something like this, but you're going to be at a disadvantage, and that's for sure. So you need, when stuff like this happens, you need to think about making a change. And like what I said, I should have made this change a long time ago. This shook me out of it. But you should always be analyzing all of the things you do and see if there's a smarter way to do it. Because just because you did something 5 years ago is not a reason to continue doing it. Even if the world hasn't changed, you have, and you're better and you're smarter. And if you relook at the way you do things, I think you can improve a lot of what you do. And in the end, you're going to deliver a better experience to your clients. You're going to get more referrals and do more business. So that is literally the McKay Mortgage business model. We're not out there doing a bunch of marketing. We're just trying to do it as smart as possible.
Thank you all so much. You were all champions to the wholesale channel and great partners. Thank you so much for just spending the time with us and sharing all of your wisdom and strategies. You're part of the reason why the brokers are so great. So thank you so much for your time today.
So the recording will be available on the ARIVE YouTube channel. So this is recorded, and in a few days, there were questions. It will be available on our YouTube channel. Thank you, everyone. Thank you so much.
Thank you guys.
Bye.
Thanks, Suresh.